Struggling to build a reliable income stream? Traditional jobs aren't the only answer. Dividend investing can provide predictable, passive income, freeing you from the daily grind. And one ETF, SCHD, is quietly becoming a favorite among those seeking a stable, growing income source. What if I told you that the Schwab U.S. Dividend Equity ETF, known by its ticker symbol SCHD, has delivered average annual returns of approximately 11.6% over the past decade? That's growth that has turned modest investments into significant wealth while simultaneously providing growing income streams. In this video, I'm going to show you exactly how to use SCHD to potentially create enough passive income to live off dividends forever. I'll break down how much you need to invest, how the dividend snowball effect works, and the exact calculations to reach that $3,000 monthly income goal. Here's the reality most investors face today. Low-yield savings accounts that barely keep up with inflation, a volatile stock market that keeps many people on the sidelines, and the uncertainty of how much you actually need to invest to reach your financial goals. You might be asking yourself, is SCHD a good investment for the long term? How much do I need to invest to generate meaningful income? And most importantly, can I actually trust this ETF to deliver consistent returns over time? These are valid concerns, especially when you're trying to build a reliable income stream for retirement or financial independence. According to a recent Bureau of Labor Statistics report, the average American household spends about $5,000 per month on living expenses. That's why our target of $3,000 monthly from dividends would cover a substantial portion of most people's needs. The Schwab U.S. Dividend Equity ETF, SCHD, has established itself as one of the most respected dividend ETFs in the market, and for good reason. As of February 2025, SCHD holds approximately $69.2 billion in assets under management, making it one of the largest dividend-focused ETFs available. What makes SCHD particularly attractive is its unique combination of current income and growth potential. With a current dividend yield of approximately 3.5%, it provides substantial income compared to the S&P 500's yield of only about 1.5 to 1.7%. But that's just the beginning of the story. SCHD's expense ratio is an incredibly low 0.06%, meaning you keep more of your investment returns instead of paying high fees. The fund tracks the Dow Jones U.S. Dividend 100 Index, focusing on 100 high-quality dividend-paying companies with strong fundamental metrics. Why SCHD works? Let's dig into why SCHD has become such a cornerstone for dividend investors and how it could potentially work for you. First, it's important to understand the SCHD holding strategy. Unlike some dividend ETFs that simply chase the highest current yields, which can be a warning sign of troubled companies, SCHD employs a more sophisticated approach. It selects companies based on 4 fundamental factors: cash flow to debt ratio, return on equity dividend yield, 5-year dividend growth rate. This methodology ensures that SCHD stocks are not just paying dividends, but have the financial strength to maintain and grow those dividends over time. Companies must have at least 10 consecutive years of dividend payments to even be considered. Let's look at Harry's situation. Harry is 45 years old and wants to retire by age 60 with enough dividend income to cover his basic expenses. He's wondering if SCHD could be the right vehicle to help him achieve this goal. The key to Harry's success will be understanding the power of SCHD's dividend growth. Over the past 12 years, SCHD has increased its dividend every single year, with a 5-year dividend growth rate of approximately 12 to 13%. This means that not only is Harry getting that initial 3.5% yield, but those dividend payments have been growing at a rate that significantly outpaces inflation. SCHD's sector allocations also play a crucial role in its performance. As of February 2025, the ETF has its largest allocations in financials, 17.7%, healthcare, 17.6%, consumer staples, 14.8%, industrials, 12.5%, energy, 11.8%. This diversification across defensive and economically sensitive sectors helps the fund perform relatively well in different market environments. Looking at SCHD's historical returns, we can see impressive consistency. The fund has delivered 1-year total return, approximately 13% 3-year annualized return, around 6.7% 5-year annualized return, about 12.5% 10-year annualized return, roughly 11.6%. Since inception, October 2011, approximately 13% annualized. These figures demonstrate SCHD's long-term performance advantage, especially when compared to many other dividend-focused ETFs. The dividend snowball effect. Now let's talk about something powerful that can transform Harry's investment: the SCHD snowball effect through dividend reinvestment. This is where the magic really happens. When you DRIP, dividend reinvestment plan, with SCHD, you're putting your dividends to work by automatically purchasing more shares. Each new share then generates its own dividends, which buy more shares, creating a powerful compounding effect. For example, if Harry invests $100,000 in SCHD today at its current price of about $28.34 per share, he would own approximately 3,528 shares. With the current annual dividend of around 99 cents per share, he would receive about $3,493 in dividends the first year. Instead of spending that $3,493, if Harry reinvests it, he'll purchase about 123 additional shares, assuming the share price stays the same. Now he has 3,651 shares generating dividends. In year 2, assuming the same dividend rate, he'd receive $3,614 in dividends. But remember, SCHD has been increasing its dividend at about 12% annually. So if we apply a more conservative 8% dividend growth rate, Harry's dividend in year 2 would actually be about $3,768. This is how the snowball starts to roll, getting bigger each year through the power of compound interest and dividend growth. Investment strategy: building your SCHD portfolio. Now, let's talk about how Harry should approach building his SCHD portfolio for maximum effectiveness. While SCHD is excellent as a core holding, the most effective strategy often involves combining it with other complementary investments. First, let's consider allocation. For someone like Harry with a 15-year timeline to retirement, a substantial allocation to SCHD makes sense, perhaps 30 to 50% of his equity portfolio. Why? Because SCHD for retirement provides that perfect balance of current income, dividend growth, and capital appreciation. But Harry shouldn't put all his eggs in one basket. A well-rounded portfolio might include SCHD, 40% for quality dividend stocks with growth, a total market index fund, 30% for broader market exposure, an international dividend ETF, 15% for geographical diversification, a bond allocation, 15% for stability and income. As Harry gets closer to retirement, he could gradually increase his allocation to SCHD and other income-producing investments. Another key strategy is dollar cost averaging. Rather than investing a lump sum all at once, Harry could invest a fixed amount regularly, perhaps monthly or quarterly. This approach reduces the impact of market volatility and can potentially improve long-term returns. Harry should also consider the account type for holding SCHD. For tax efficiency, it's often best to hold dividend-paying investments in tax-advantaged accounts like IRAs or 401ks. However, SCHD predominantly pays qualified dividends, which are taxed at lower rates than ordinary income, making it relatively tax-efficient even in taxable accounts. Finally, Harry should create a SCHD calculator spreadsheet to track his progress. This should include number of shares owned quarterly and annual dividend income, dividend growth rate, projected future income, total return, dividends plus price appreciation. This tracking mechanism will help Harry stay motivated as he watches his dividend snowball grow over time. Numerical examples: path to $3,000 monthly. Now, let's get to the heart of our question. Exactly how much does Harry need to invest in SCHD to generate $3,000 in monthly dividend income? Let's run the numbers using SCHD's return calculator approach. $3,000 per month equals $36,000 per year in dividend income. With SCHD's current dividend yield of 3.5%, a simple calculation would be $36,000 divided by 0.035 equals $1,028,571. So, at first glance, Harry would need just over $1 million invested in SCHD to generate $36,000 in annual dividend income at today's rates. But that's not accounting for SCHD's dividend growth over time. Let's see how different initial investments could grow to potentially reach that $3,000 monthly target. Scenario 1. $500,000 initial investment. If Harry invests $500,000 in SCHD today, Year 1. $17,500 in dividends, $1,458 per month. Year 5. $25,730 in dividends, $2,144 per month, assuming 8% annual dividend growth. Year 10. Approximately $37,850 in dividends, $3,154 per month. So, with a $500,000 investment, Harry could potentially reach his $3,000 monthly income goal in about 9 to 10 years through dividend growth alone, without even considering share price appreciation. Scenario 2. $250,000. Initial investment plus $1,500. Monthly contributions. If Harry starts with $250,000 and adds $1,500 monthly, Year 1. Approximately $8,750 in dividends, plus approximately $18,000 in contributions. Year 5. Approximately $20,500 in dividends, $1,708 per month. Year 10. Approximately $36,400 in dividends, $3,033 per month. In this scenario, Harry reaches his goal in about 10 years through a combination of initial investment, ongoing contributions, and dividend growth. Scenario 3. $100,000. Initial investment plus $2,500 monthly contributions. If Harry starts with $100,000 and adds $2,500 monthly, Year 1. $3,500 in dividends plus $30,000 in contributions. Year 5. $15,700 in dividends, $1,308 per month. Year 10. $32,500 in dividends, $2,708 month. Year 12. $38,400 in dividends, $3,200 month. Here, Harry would reach his $3,000 monthly goal in about 12 years. Now let's look at the truly long-term potential. If Harry invests $100,000 in SCHD today and reinvests all dividends based on SCHD's historical returns of approximately 11.6% annually, including dividends, his investment could grow to 10 years, approximately $300,000 20 years, $900,000 30 years, $2.7 million. At that 30-year mark, assuming a 3.5% dividend yield, Harry's annual dividend income would be about $94,500 or $7,875 per month, far exceeding his initial $3,000 monthly goal. This demonstrates the incredible power of living off dividends through long-term investing in quality dividend ETFs like SCHD. The advantages of SCHD for income investors. Before wrapping up, let's highlight why SCHD is particularly well-suited for building a dividend income stream. Quality focus. SCHD's methodology selects financially strong companies, reducing the risk of dividend cuts. Growth component. Unlike some high-yield investments that offer little growth, SCHD has delivered solid capital appreciation alongside its dividends. Low expenses. With an expense ratio of just 0.06%, more of your money stays invested and working for you. Diversification. With approximately 100 holdings across multiple sectors, SCHD provides built-in diversification. Track record. Since its inception in 2011, SCHD has increased its dividend every year and delivered strong total returns. So that's how SCHD can potentially build a substantial dividend income. Whether your goal is $3,000 monthly or something else, invest consistently, reinvest dividends, and let time work. Remember, SCHD's long-term performance is impressive, but past results don't guarantee the future. Always do your due diligence and consider consulting a financial advisor. If this SCHD analysis helped, hit like and subscribe. Are you currently invested in this ETF? What's your target monthly dividend income? Want to see a breakdown of other dividend ETFs that pair well with SCHD? Let me know in the comments and I'll create that video next. Thanks for watching, and here's to building your dividend snowball.